Most people think the crypto market is about technology. They're wrong. When I was running Renaissance Technologies, we discovered something fascinating. Markets aren't driven by fundamentals, by news, or even by logic. They're driven by patterns, invisible patterns that repeat themselves with mathematical precision. The crypto market, it's the most beautiful chaos I've ever seen. Here's what nobody tells you. While everyone's arguing about Bitcoin going to $1 million or crashing to zero, there's a hidden layer underneath, a layer of liquidity pools, market makers, and algorithmic forces that are actually moving prices. And once you understand how this machinery works, you stop being surprised by the volatility. You start seeing it for what it really is. Today, I'm going to show you the three mechanisms that control 90% of crypto price movements, mechanisms that have nothing to do with what you read on Twitter and everything to do with mathematics, game theory, and human psychology. By the end of this, you won't look at a Bitcoin chart the same way again. Let's start with something simple. Why does Bitcoin crash exactly when retail investors are most bullish? The answer isn't manipulation. It's much more interesting than that. You walk into what looks like a free market. Bitcoin, Ethereum, thousands of altcoins trading 24 hours a day across hundreds of exchanges. It feels democratic, decentralized, open to anyone with an internet connection. But here's what most retail investors don't realize: the game is already rigged before you even place your first trade. Not by some shadowy conspiracy, but by mathematical necessity and economic incentive structures that have existed since the first financial markets were created. Market makers are the invisible hand controlling 70% of all crypto liquidity. These aren't the enthusiastic holders you see on social media. These are sophisticated firms with algorithms running on servers located as close as physically possible to exchange data centers. They're making thousands of trades per second, and their job isn't to bet on whether Bitcoin goes up or down. Their job is to profit from the spread between buyers and sellers, and in doing so, they control the very infrastructure of price discovery. Think about what happens when you want to buy Bitcoin. You open your exchange app, you see a price, and you click buy. Simple, right? But what you're actually doing is taking liquidity from a market maker who has already placed that sell order. They're not selling because they think Bitcoin will go down. They're selling because simultaneously, on the other side of the order book, they've also placed a buy order slightly lower. When someone sells to them, they profit from that spread. Multiply this by millions of transactions, and you begin to see the machine. The fascinating part is how this concentration of liquidity creates asymmetric information. Market makers see the entire order book in real time. They see large orders coming in before they're executed. They see the momentum building before retail investors even open their apps. This isn't insider trading in the traditional sense, but it's an enormous structural advantage. When a whale wants to buy $50 million worth of Ethereum, they can't just market buy it all at once without moving the price dramatically against themselves. So they break it into smaller orders. They use algorithms. They try to hide their intentions. But market makers can detect these patterns. They can run the order flow legally, and profit from the predictable price movement. Here's where it gets even more interesting. During periods of extreme volatility, when retail investors are panic selling or FOMO buying, market makers often pull their liquidity entirely. They widen their spreads or simply disappear from the order book. This is when you see those violent price swings, those long wicks on the charts where Bitcoin drops 15% in 3 minutes and then recovers. It's not organic selling pressure. It's a temporary liquidity vacuum. The market makers know that in a panic, they can't accurately price risk, so they step aside and let the chaos unfold. Then, when things stabilize, they come back and profit from the aftermath. The consolidation is accelerating too. A handful of firms now dominate market making across most major exchanges. They have exclusive agreements, rebate structures, and privileged API access that retail traders will never get. Some exchanges even use their own internal market makers, creating an obvious conflict of interest. The exchange profits when you lose, and their market maker is on the other side of your trade. This isn't to say you can't make money in crypto. But you need to understand that you're not trading in a vacuum. Every order you place is visible to entities with more capital, better technology, and structural advantages that are baked into the system itself. The sooner you accept this reality, the sooner you can start thinking like a market maker instead of being their counterparty. Imagine you're watching the order book on your favorite exchange. You see a massive sell wall appear, 50 Bitcoin offered at $43,000. It looks terrifying. Other traders see this wall and think someone knows something they don't. Maybe a crash is coming. So they start selling too, pushing the price down. But here's the thing: that sell wall was never meant to be executed. The moment the price drops to 42,000, the wall disappears, vanishes completely, and the same trader who placed it starts buying at the lower price. Welcome to spoofing, and it happens thousands of times a day across every major cryptocurrency exchange. Spoofing is the art of creating false signals in the order book to manipulate other traders' behavior. It's illegal in traditional markets. The CFTC has fined traders millions for doing this with gold and treasury bonds. But in crypto, where regulation is fragmented and enforcement is minimal, it's essentially the Wild West. The same tactics that would land you in prison for manipulating stock prices are happening right now in real time on exchanges that process billions of dollars in daily volume. Layering is spoofing's sophisticated cousin. Instead of placing one large fake order, a trader places multiple orders at different price levels, creating the illusion of deep liquidity or strong buying and selling pressure. Let's say Bitcoin is trading at 42,500. A layer bot might place buy orders at 42,400, 42,300, 42,200, and so on, each progressively larger. To other market participants, this looks like incredible support. Strong hands willing to defend these price levels. So traders feel confident buying at 42,500, thinking they have protection below. But as soon as those buy orders at the current price get filled, all those lower support orders disappear instantly. They were never real. The price collapses through those levels like they never existed, and the manipulator has already sold their position to the traders who thought they were buying into strength. The mathematical sophistication of these operations is impressive. Modern spoofing algorithms don't just place and cancel orders randomly. They analyze order flow velocity. They detect other algorithms in the market. They calculate the optimal size and timing to create maximum psychological impact without being too obvious. Some use machine learning to adapt their strategies based on how the market responds. They're playing a game of deception at microsecond timescales that human traders simply cannot perceive. What makes this particularly insidious in crypto is the fragmented liquidity across exchanges. A spoofing operation doesn't need to manipulate the entire market, just one exchange where they can move the price enough to trigger arbitrage, bots that will then carry that price movement to other venues. It's a leverage effect. Manipulate Binance, and within seconds, Coinbase and Kraken follow. The manipulator only needed capital on one platform to influence the global price. The exchanges know this is happening. Their surveillance systems can detect abnormal cancel rates and order book patterns. But enforcement is inconsistent at best. Some exchanges have delisting warnings or trading restrictions, but these are rarely publicized. The incentive structure doesn't favor aggressive enforcement either. High-frequency spoofing creates trading volume, and exchanges profit from trading fees. There's an uncomfortable truth here: the chaos is profitable for the infrastructure providers. For retail traders, the lesson is brutal but necessary. The order book you're looking at is not an honest representation of supply and demand. It's a battlefield where sophisticated actors are constantly feinting, deceiving, and manipulating. Those walls you see, assume they're fake until proven otherwise. That sudden surge of buying pressure, it might evaporate the moment you follow it. Trading crypto means operating in an environment where the very information you're basing decisions on may be deliberately falsified. Understanding this doesn't give you an edge, but it might prevent you from being the edge for someone else. Most people trading crypto have never opened a perpetual futures contract, but the funding rate from these instruments controls more price action than almost anything else in the market. It's one of those invisible mechanisms that retail investors don't see but feel every single day in their portfolio. Understanding funding rates is like discovering that there's been a second game happening underneath the one you thought you were playing, and that second game has bigger stakes and smarter players. Here's how it works. Perpetual futures are contracts that let you bet on Bitcoin's price without ever actually owning Bitcoin. Unlike traditional futures that expire, perpetual contracts never settle. You can hold them indefinitely. But this creates a problem: what keeps the futures price tethered to the actual spot price of Bitcoin. In traditional markets, futures converge to spot prices at expiration through arbitrage. But if there's no expiration, you need a different mechanism. That mechanism is the funding rate. The funding rate is a small periodic payment between long and short positions. When the futures price is trading above the spot price, meaning more people are bullish and buying longs, the funding rate becomes positive. Long positions pay short positions. This incentivizes traders to close longs and open shorts, which brings the futures price back down towards spot. When futures trade below spot, shorts pay longs, incentivizing the opposite. It's an elegant mathematical solution to keep synthetic and real prices aligned without requiring expiration dates. But here's where it gets interesting for price manipulation and cascading volatility. During bull markets, when retail enthusiasm is high and everyone's leveraged long, funding rates spike to extreme levels. We're talking 1% per day or higher, which annualized is over 365%. These aren't overnight rates, they're paid every 8 hours. If you're holding a leveraged long position, you're bleeding massive amounts of capital just to maintain your position, even if the price isn't moving. This creates unsustainable positions that must eventually close. Smart money watches funding rates like hawks. When funding becomes excessively positive, they know the market is overleveraged to the long side. This is when they strike. They start selling spot Bitcoin and shorting futures simultaneously, pushing the price down. As the price drops, all those highly leveraged longs hit their liquidation points. When you get liquidated, the exchange forcibly closes your position by selling, which adds more selling pressure. This triggers more liquidations in a cascading effect. Funding rates that were positive 3% suddenly flip negative as longs get wiped out and shorts dominate. The same mechanism that was bleeding longs is now bleeding shorts, but by then the damage is done. The brilliance of this system is that it's entirely transparent and predictable, yet retail traders consistently ignore it. Exchanges publish funding rates in real time. You can see when positions are dangerously imbalanced. But the psychological pull of a rallying market overwhelms rational analysis. Traders see Bitcoin pumping, they see their portfolio going up, and they lever up more. They ignore that they're paying 300% annualized just to hold their position. They don't realize they're voluntarily putting themselves in a position where any small price correction becomes catastrophic. Professional traders do the opposite. They farm funding rates. When rates are extremely positive, they short the futures and buy the spot, collecting that funding payment while remaining market neutral. When rates flip negative, they reverse the trade. It's essentially free money extracted from the imbalanced positions of retail traders who don't understand the mechanics they're participating in. The funding rate isn't hidden knowledge. It's publicly available data. But like so much in crypto, the information is there, and most people simply don't look at it until it's too late. By the time you notice funding rates have been elevated for days, you're probably already the liquidity that's about to get harvested. When you look at the trading volume on a cryptocurrency exchange, you're seeing a number that should represent real economic activity, buyers meeting sellers, price discovery happening through genuine supply and demand. But in reality, somewhere between 40 and 60% of the volume you see on smaller and mid-tier exchanges is completely fake. It's wash trading, the same entity buying and selling to itself to create the illusion of liquidity and activity. And this isn't a conspiracy theory. Multiple academic studies by blockchain forensics firms and even the exchanges themselves have quietly acknowledged this as standard practice. Here's why it happens. Exchanges are businesses competing for users and listings. A new project wants to list their token, and they're choosing between 10 different platforms. What's the first thing they look at? Trading volume. An exchange doing $1 billion a day looks legitimate and liquid. An exchange doing 10 million looks like a ghost town. So exchanges have enormous incentive to inflate their numbers. Some do it directly through internal trading operations. Others allow or even encourage market makers to wash trade in exchange for rebates and fee discounts. The result is the same fabricated volume that misleads everyone looking at the data. The mechanics are simpler than you'd think. An entity controls multiple accounts on the same exchange. They place a buy order from account A and simultaneously place a sell order from account B at the same price. The trade executes, volume increases, but no actual change in ownership occurred. No real capital was at risk. The exchange might even rebate the trading fees, making it cost neutral or even profitable to generate fake volume. Multiply this by thousands of trades per minute using automated bots, and suddenly a sleepy exchange looks like it's doing massive business. What makes this particularly damaging is how it corrupts every downstream analysis. Traders use volume as a confirmation signal. They think high volume means strong conviction that big players are participating. Technical analysts look at volume spikes to validate breakouts or breakdowns. But if half that volume is fake, all those signals become meaningless. You're reading tea leaves that were deliberately arranged to deceive you. Projects choose to list on exchanges based on fabricated metrics. Investors allocate capital based on liquidity that doesn't actually exist. The entire information ecosystem becomes polluted. The really sophisticated wash trading isn't even detectable by looking at the order book. Some operations use what's called layered wash trading, where they route orders through multiple intermediary accounts and stagger the timing to make it look organic. They'll vary the order sizes, introduce slight price differences, and mix in enough real trades that pattern detection becomes nearly impossible. Blockchain analytics firms have developed machine learning models to identify these patterns, and what they've found is disturbing. On some exchanges, during certain hours, essentially 100% of the volume is circular trades between related entities. Why don't regulators stop this? In jurisdictions with strong financial oversight, they're trying. The SEC has brought cases against crypto projects for wash trading. But most exchanges operate in regulatory gray zones or jurisdictions where enforcement is minimal. Some are incorporated in places specifically chosen because financial crime prosecution is unlikely. And even when caught, the penalties are often trivial compared to the competitive advantage gained from appearing to have high volume. For you as a trader, this creates a dangerous environment. You might think you're entering a liquid market where you can exit your position easily. But when you try to sell, you discover the volume was fake and there are no real buyers. The spread widens dramatically. Your slippage is massive. That liquidity you thought you were paying for through trading fees never actually existed. The only real defense is to stick with Tier 1 exchanges that have regulatory pressure and reputational risk that makes wash trading less likely. But even then, you're operating in a market where the volume numbers are fundamentally unreliable, and that uncertainty is baked into every decision you make. There's a strange reality at the heart of cryptocurrency markets that most people don't want to acknowledge. The entire ecosystem runs on a digital dollar created by a private company with opaque banking relationships and no meaningful audit. Tether, the stablecoin pegged to the US dollar, processes more daily volume than Bitcoin itself. It's the lubricant that makes the machine run, and if it ever breaks, the entire crypto market could seize up in ways that would make previous crashes look tame. Here's why Tether matters so much. When you want to move money between cryptocurrencies quickly, you don't convert Bitcoin to Ethereum directly. You convert Bitcoin to Tether, then Tether to Ethereum. When you want to take profits, you don't wire dollars off an exchange that takes days and costs significant fees. You convert to Tether and leave it there, ready to deploy. When exchanges need to provide liquidity across hundreds of trading pairs, they don't hold deep reserves of every random altcoin. They hold Tether and use it as the universal intermediary. It's become the de facto reserve currency of crypto, processing over $50 billion in daily transactions across every major exchange. The problem is trust. Tether claims every token is backed 1-to-1 by real dollars or dollar equivalents in reserve. For years, they refused to provide audits. When they finally released attestations, they weren't real audits. They were limited reviews that didn't verify the quality or accessibility of the reserves. The documents showed reserves that included commercial paper, secured loans, and other assets that aren't the same as cash in a bank account. We've never seen proof that Tether can redeem all tokens simultaneously if there's ever a serious run on the system. The history is even more concerning. Tether has had banking relationships cut repeatedly. They've been investigated by the Department of Justice. The New York Attorney General found they had made false statements about their reserves and had covered up massive losses. They paid an $18 million settlement but admitted no wrongdoing. Despite all of this, the token continues to function and trade at its dollar peg because the market needs it to function. It's too big to fail, not because governments would bail it out, but because letting it fail would mean the collapse of liquidity across the entire crypto market. Think about what happens if Tether breaks its peg. Let's say tomorrow Tether starts trading at 90 cents instead of $1. Suddenly, every exchange has a massive hole in its balance sheet. If they're holding $1 billion Tether as reserves, they just lost $100 million. Market makers who are providing liquidity across dozens of trading pairs using Tether as their base asset suddenly can't accurately price anything. Does Bitcoin cost 42,000 Tether, or does it cost $42,000 worth of an asset that's only worth 90 cents? The entire concept of price discovery collapses because the measuring stick itself has become unreliable. The cascading effects would be catastrophic. Arbitrage breaks down because you can't arbitrage between a stable dollar and an unstable Tether. Traders would rush to exit Tether positions, but into what? If everyone's selling Tether for Bitcoin simultaneously, Bitcoin's price would spike artificially, but that wouldn't represent real value. It would represent panic flight from a failing currency. Exchanges might freeze Tether withdrawals to prevent bank run dynamics, which would only accelerate the panic. And yet here we are. Tether continues to mint new tokens billions at a time whenever the market needs liquidity. During bull runs, Tether creation often precedes price pumps. Some researchers argue this is Tether being printed to artificially inflate prices, though Tether claims they only mint when users deposit dollars. The truth is probably somewhere in between, but the opacity makes it impossible to know. What we do know is that the entire crypto economy has built itself on a foundation that requires trusting a private company that has repeatedly been caught in misrepresentations. It's a systemic risk that everyone acknowledges but nobody can do anything about, because the alternative, operating without Tether, would mean accepting dramatically lower liquidity and functionality across every market. So we collectively pretend the risk doesn't exist and hope the foundation never cracks. The price of Bitcoin on Binance is $42,300. On Coinbase, it's $42,500. On Kraken, it's $42,200. These differences shouldn't exist for more than a few seconds, and yet they emerge constantly throughout the day. The moment they appear, an invisible army of trading bots springs into action, buying on the cheaper exchange and selling on the expensive one, pocketing the difference. This is arbitrage, and it's the force that keeps global crypto prices synchronized. But what looks like a simple profit opportunity is actually a sophisticated technological arms race that reveals how fragmented and inefficient crypto markets really are. Pure arbitrage seems like free money. Buy low, sell high, no directional risk. But in practice, it's extraordinarily competitive and capital-intensive. The profitable window might only exist for 200 milliseconds. By the time a human sees the price discrepancy and clicks a button, it's already gone. Professional arbitrage operations use collocated servers positioned as close as physically possible to exchange data centers, specialized fiber optic connections, and custom-built software that can detect and execute trades in microseconds. They're not competing against retail traders. They're competing against other machines in a technological arms race where milliseconds determine profitability. The capital requirements are massive, too. To capture a 1% price difference, you need to move serious volume to make meaningful profit. But you also need to maintain large balances on multiple exchanges simultaneously because moving funds between exchanges takes time. If you have to deposit Bitcoin to Kraken before you can sell it there, the arbitrage opportunity will be long gone. So sophisticated operations keep millions of dollars parked across 5 or 10 different exchanges just sitting there waiting for opportunities. That's capital that's not earning yield elsewhere, not being used for other strategies. It's the cost of being ready. Cross-exchange arbitrage also reveals liquidity fragmentation. The fact that price differences persist at all, even for seconds, shows that crypto markets aren't truly unified. There are dozens of separate pools that communicate through arbitrageurs. When a big buy order hits Binance and moves the price up, it doesn't instantly affect Coinbase. Arbitrage bots detect the difference, buy on Coinbase and sell on Binance, which pushes Coinbase up and Binance down until equilibrium is restored. The bots are literally the transmission mechanism that propagates price discovery across venues. Without them, exchanges would drift apart into completely separate markets. This creates interesting dynamics during volatility. When Bitcoin crashes hard, arbitrage often breaks down temporarily. Price discrepancies can reach 5 or even 10% between exchanges. Why? Because arbitrage requires being able to execute both sides of the trade quickly. In a crash, some exchanges might have frozen deposits or withdrawals. Order books might be too thin to execute large orders without massive slippage. The risk increases that you'll get stuck holding depreciating assets on one exchange while unable to complete the other side. So arbitrageurs pull back, and the markets fragment further, which increases volatility even more. There's also triangular arbitrage within single exchanges. Bitcoin to Ethereum, Ethereum to Tether, Tether back to Bitcoin. If the exchange rates aren't perfectly balanced, you can profit from the loop. These inefficiencies are tiny, often just a few basis points, but automated systems execute thousands of these cycles per hour. They're essentially extracting rent from the exchange's pricing engine, and in doing so, they keep the various trading pairs properly aligned with each other. The sophistication of modern arbitrage operations has essentially eliminated easy opportunities for outsiders. By the time you calculate an arbitrage exists, the bots have already taken it. What remains are smaller inefficiencies, higher risks, or opportunities that require technology and capital that retail traders simply don't have access to. The arbitrageurs provide a valuable service. They create the illusion of a unified global market. But they're also extracting value from every transaction, a hidden tax that makes markets slightly more efficient for everyone else while concentrating profits among those with the best technology. Picture a Bitcoin trader who's been riding the bull market with 10 times leverage. They bought Bitcoin at $40,000, but they only put up 10% of the capital. The exchange lent them the rest. Bitcoin rallies to 45,000 and they're feeling brilliant, but then a moderate correction begins. Bitcoin drops to 41,000, then 40,500. Suddenly their position is underwater. At 40,000, they've lost their entire initial capital. The exchange automatically closes their position to recover the borrowed funds. This is liquidation, and when it happens to thousands of traders simultaneously, it creates a cascading effect that can crash the market far beyond what any fundamental event would justify. The mathematics of liquidation cascades are brutally simple. Highly leveraged positions have narrow margins before they hit their liquidation price. A trader with 20 times leverage can only sustain a 5% move against them before getting liquidated. 100 times leverage. They're liquidated on a 1% move. During volatile periods, these positions stack up like dominoes. When the first wave gets liquidated, their forced selling pushes the price down further, which triggers the next wave of liquidations, which pushes the price even lower. It's a self-reinforcing death spiral that has nothing to do with actual supply and demand fundamentals and everything to do with leverage mechanics. What makes this particularly insidious is that sophisticated traders know exactly where these liquidation clusters sit. Blockchain analytics and exchange data leak information about leveraged positions. When whales see massive liquidation walls sitting at a particular price level, they can deliberately push the market into that zone and triggering the cascade and then buy back cheaper after the forced liquidations are complete. It's not even technically manipulation. They're just exploiting the predictable behavior of an over-leveraged market. The liquidations create artificial volatility that generates profit opportunities for anyone with enough capital to move the market and enough patience to wait for the setup. The long-short ratio that exchanges publish gives this game away. When 80% of traders are long with high leverage, smart money knows a liquidation cascade is ready to trigger. They don't need to crash the market dramatically, just push it down 5 or 10%. The leverage does the rest of the work. Billions of dollars in long positions get forcibly closed, creating selling pressure that drops the price another 10 or 15%. By the time the cascade finishes, Bitcoin might be down 25% from a structural vulnerability, not from any actual news or fundamental change. The psychological damage compounds the mechanical damage. Retail traders who get liquidated don't just lose their position, they lose their entire capital. They're not sitting on the sidelines with cash ready to buy the dip. They're broke, angry, and out of the game. Meanwhile, the traders who triggered the cascade are buying at depressed prices from the forced sellers who have no choice but to exit. It's a wealth transfer mechanism dressed up as market volatility. Exchanges profit from this chaos too, which creates misaligned incentives. Every liquidation generates fees. High leverage generates higher trading volume. Some exchanges offer 50 or even 100 times leverage, knowing it's essentially a trap for inexperienced traders. They market it as opportunity when it's really just a faster way to lose money. The house always wins because liquidations guarantee the exchange recovers the borrowed funds plus fees, while the trader absorbs 100% of the loss. The recovery from liquidation cascades reveals their artificial nature. After Bitcoin drops 25% in an hour, it often rebounds 10 or 15% almost immediately. There was no fundamental justification for the crash, it was mechanical. But the damage is done. Leveraged longs are wiped out, fear dominates the market, and capital that was deployed enthusiastically at higher prices is now gone. The cascade doesn't just create volatility, it redistributes wealth from impatient, over-leveraged retail traders to patient, well-capitalized professionals who understand the game being played. If you're trading with high leverage, you're not investing in crypto. You're gambling against people who can see your cards and know exactly when to push you all in. Most people think crypto trading happens in the dark. Anonymous wallets, untraceable transactions, complete privacy. The reality is exactly the opposite. Every single Bitcoin transaction is permanently recorded on a public ledger that anyone can analyze. When a whale moves 1,000 Bitcoin from one wallet to another, blockchain analytics firms see it in real time. When an early investor consolidates their holdings, it's visible. When exchange wallets transfer funds between hot and cold storage, researchers track it. This transparency creates an intelligence layer that sophisticated traders exploit while retail investors remain blind to the information flowing right past them. Whale wallets are particularly revealing because large holders can't hide their positions or movements. If someone controls 50,000 Bitcoin, that's not sitting in one wallet. It's probably distributed across dozens or hundreds of addresses for security. But blockchain forensics can cluster these addresses together by analyzing transaction patterns, timing, and common input ownership. They can build a map of who controls what, and more importantly, when they're moving funds in preparation for selling. This is intelligence that moves markets. When a wallet that's been dormant for 3 years suddenly becomes active, that's a signal. Old Bitcoin moving is often someone who bought early and is finally taking profits. If they're moving it to an exchange, they're probably planning to sell. Analytics firms track these flows and sell this data to hedge funds and trading desks. By the time retail investors see a price dump and wonder what happened, professionals already knew 12 hours earlier that a whale was moving coins toward exchanges. The information asymmetry is structural. The supply dynamics revealed by on-chain data are even more important than individual whale movements. You can track exactly how much Bitcoin is sitting on exchanges versus in cold storage. When exchange balances drop, it means people are withdrawing to hold long-term. That's bullish because it reduces available supply for selling. When exchange balances increase dramatically, it's bearish because it means people are moving coins to exchanges in preparation for selling. This isn't speculation or technical analysis, it's observable reality. The Bitcoin is physically moving to places where it can be sold. Long-term holder behavior is another crucial metric. Blockchain analysis can identify wallets that haven't moved their Bitcoin in over a year and classify them as strong hands or outliers. When these wallets start spending after years of dormancy, it signals that even the most convicted holders are capitulating or taking profits. This happened near the top of every major cycle. Conversely, when long-term holder supply increases during bear markets, it shows accumulation by people planning to hold through volatility. These are leading indicators that precede price movements by weeks or months. The transparency cuts both ways, though. Large investors trying to accumulate without moving the price have to be incredibly careful. If they send $1 billion to Coinbase in one transaction, every analytics firm and their subscribers will see it. The market will front-run them, driving the price up before they can finish buying. So sophisticated buyers use elaborate strategies, breaking purchases across dozens of wallets and exchanges, using OTC desks that don't touch public order books, timing their moves during low liquidity periods. But even these strategies leave traces that analysts can detect. What retail investors don't realize is that they're trading with incomplete information while others have real-time intelligence. By the time news hits Twitter that a whale moved funds, the smart money already repositioned. By the time you notice exchange balances are rising, the dump might already be underway. The blockchain is public, but extracting actionable intelligence from it requires expensive tools, technical expertise, and the kind of systematic analysis that retail traders simply don't do. The cruel irony is that crypto is supposed to democratize finance, but on-chain analytics has created a new form of information asymmetry. Those who can read the blockchain effectively have insider-level intelligence legally. They see the supply, they see the flows, they see the whale movements. Everyone else is trading blind, making decisions based on price charts and social media sentiment, while the actual money flows are visible to anyone willing to look. The data is public, but the interpretation and speed of analysis creates the same advantages that insider information provides in traditional markets, except it's completely legal. There's a pattern that repeats itself in crypto with mathematical precision. So predictable, you could set your watch by it. Yet retail investors fall for it every single time. It's called the pump and dump cycle, and it moves through three distinct phases: accumulation, markup, and distribution. Understanding this cycle doesn't just explain how you lose money, it explains how the entire altcoin ecosystem is designed to transfer wealth from impatient retail traders to patient, coordinated groups who understand market psychology better than you understand yourself. Accumulation is the silent phase. A token has crashed from its previous high, maybe down 80 or 90%. Trading volume is dead. Nobody's talking about it anymore. The Telegram group is a ghost town. This is exactly when the smart money enters. They're not buying on market orders that would spike the price. They're placing patient limit orders, absorbing every small sell that comes through, slowly building a position over weeks or months. They might control 30 or 40% of the circulating supply by the time they're done, and they did it so quietly that nobody noticed. The price barely moved. To everyone watching, the token just looks dead. Then comes the markup phase, and this is where the artistry happens. The accumulators start buying more aggressively, creating visible upward price movement. 5% one day, 8% the next. Nothing dramatic enough to seem like manipulation, but consistent enough that technical traders start noticing. The charts look bullish. Higher lows, higher highs, clean up trends. Momentum indicators turn positive. At this point, the project itself often releases some positive news, a partnership announcement, an exchange listing, a product update that was probably planned months ago but strategically timed for maximum impact. The price jumps 20% in a day. Now social media kicks in. Crypto influencers who were completely silent during accumulation suddenly can't stop talking about this hidden gem. YouTube videos appear with titles like, "This coin will 10x," with shocked face thumbnails. Twitter accounts with huge followings start shilling it. Some of these influencers are paid directly by the accumulators. Others are just momentum chasers trying to ride engagement. Either way, they're doing the marketing work for free. Retail FOMO builds. People who watch the token sit dead for months suddenly can't buy fast enough. They're afraid of missing out on the next 100 times return. The price goes parabolic, 50% gains in a day, then another 30% the next day. Trading volume explodes. New buyers flood in, many of them using leverage because they want to maximize gains. The token might genuinely 10 times from its accumulation lows. Everyone who bought in the markup phase feels like a genius. They're posting screenshots of their gains, telling their friends to buy. This is the emotional peak, the euphoria phase where rational analysis disappears and greed takes over. And that's when distribution begins. The accumulators who bought at the bottom start selling. But they're not panic dumping. That would crash the price and reduce their profits. They're selling into strength, into the massive buy volume coming from retail FOMO. Every time the price spikes, they're selling more. They're the liquidity for every retail trader who's buying what they think is a breakout. The price might still be going up, but the smart money is rotating out. They're taking profits at 3 times, 5 times, 10 times their entry while retail is buying, convinced it's going to 100 times. Eventually, the buy pressure exhausts itself. Everyone who was going to FOMO in has already bought. The influencers move on to the next shiny object. And without constant new buyers, the price has nowhere to go but down. It starts with a small correction that gets bought immediately. This fake out-convinces late buyers that it's just a healthy pullback. But then it drops harder. The leverage longs get liquidated, creating more selling pressure. Panic replaces greed. The same retail traders who bought at the top are now selling at 50% losses, providing exit liquidity for the last of the smart money who were waiting for this final panic to unload their remaining bags. By the time it's over, the token is back down 70 or 80% from its peak. The cycle is complete. Wealth has been transferred from thousands of retail traders to a small group who understood the game. And somewhere out there, they're already accumulating the next token, preparing to run the exact same playbook again. Regulatory uncertainty in crypto isn't an unfortunate side effect of an emerging industry. It's a weapon. A tool that governments, institutions, and large players wield strategically to volatility exactly when they need it. The market doesn't crash because regulation is coming. It crashes because the threat of regulation can be deployed at precisely the moment when it benefits those who know it's coming. And the beautiful thing about regulatory uncertainty is that it never actually has to materialize into real action. The fear alone is enough to move billions of dollars. Watch the pattern. Bitcoin rallies from 30,000 to 60,000 over 6 months. Retail enthusiasm is peaking. Leverage is at all-time highs. And then suddenly, out of nowhere, a government official makes an offhand comment about potential crypto restrictions. Maybe it's a senator calling for hearings. Maybe it's the SEC chairman suggesting new enforcement actions. Maybe it's a foreign government floating the idea of a mining ban. The specifics don't matter. What matters is the headline, the fear, the uncertainty it injects into an over-leveraged market. Within hours, billions get liquidated. Prices cascade down 15 or 20%. Retail traders panic and sell. But here's the thing, nothing actually changed. No law was passed. No exchange was shut down. Just words strategically deployed into a fragile market structure. And who benefits? The institutional players who were already planning to take profits. The whales who can withstand volatility and buy the panic dip. The trading firms who profit from chaos regardless of direction. The timing is rarely coincidental. These regulatory concerns tend to surface near market tops or during periods of extreme speculation. They're used to cool overheated markets, to shake out weak hands, to create buying opportunities for those with patience and capital. And because crypto operates globally across multiple jurisdictions, there's always another regulatory threat available. If the US goes quiet, China makes noise. If China is silent, Europe floats new frameworks. If Europe is dormant, India threatens bans. There's always another shoe that could drop, another headline that could tank the market. What makes this particularly effective is that crypto genuinely does exist in regulatory gray zones. The threats aren't completely fabricated. There really could be enforcement actions. Exchanges really could face restrictions. Securities laws really might apply to certain tokens. So the fear has just enough legitimacy that even sophisticated investors can't completely ignore it. You can't call it fade and dismiss it entirely because some regulatory risk genuinely exists. That ambiguity is the weapon. The regulatory uncertainty also suppresses long-term institutional capital that could stabilize markets. Major funds can't allocate billions to an asset class where the legal framework might change overnight. So crypto remains dominated by retail traders and risk-seeking capital, which makes it more volatile, which makes it easier to manipulate through fear. It's a self-reinforcing cycle where regulatory uncertainty prevents the very maturation that would reduce manipulation. The game isn't about regulation actually arriving. It's about keeping the market in a perpetual state of uncertainty where fear can be weaponized on demand. As long as crypto exists in this liminal regulatory space, those who can manufacture or amplify uncertainty will continue to extract value from those who react emotionally to headlines that ultimately change nothing. So let me bring this all together, because if you've stayed with me through these 10 mechanisms, you now understand something that 90% of crypto traders will never grasp. The market you think you're trading in doesn't actually exist. You thought you were participating in a decentralized financial revolution, a democratized market where anyone with an internet connection has equal opportunity. But what you've actually entered is one of the most sophisticated wealth extraction machines ever created. Market makers control 70% of liquidity and see your orders before you do. Spoofing bots manipulate the very order books you're using to make decisions. Funding rates bleed your leverage positions while professionals farm those same rates risk-free. Half the volume you see is fabricated wash trading designed to make dead exchanges look alive. The entire ecosystem runs on Tether, a stablecoin backed by reserves we've never actually seen and controlled by a company that's been caught in repeated misrepresentations. Arbitrage bots are extracting rent from every inefficiency faster than you can blink. Your liquidation price is visible to whales who can deliberately trigger cascades to buy your forced selling. Every wallet movement, every transaction, every flow of coins is tracked by analytics firms selling that intelligence to hedge funds while you trade blind on price charts and Twitter sentiment. The pump and dump cycle that's robbed you 3 times this year isn't random. It's a choreographed dance with 3 predictable phases that you keep falling for. And regulatory uncertainty isn't an unfortunate reality of an emerging market. It's a manufactured volatility tool deployed strategically to shake you out at exactly the wrong moment. Here's what Jim Simons understood that most traders never will. Markets aren't about being right about the future. They're about understanding the structure of the game being played. When I ran Renaissance, we didn't try to predict whether stocks would go up or down. We identified patterns in the machinery itself, the mechanics of how markets actually function beneath the surface noise. Crypto's no different. Actually, it's more transparent. The blockchain shows you everything. The order books are visible. The liquidation levels are calculable. The on-chain flows are trackable. The information is all there. But information without understanding is worse than useless. It gives you false confidence while you're being systematically harvested. Does this mean you can't make money in crypto? Of course not. But you need to stop thinking like a retail trader and start thinking like the people on the other side of your trades. Stop watching price and start watching structure. Stop following influencers and start following the actual movement of coins. Stop using high leverage and start understanding funding rates. Stop buying the breakout and start recognizing the distribution phase. The game is rigged, but it's not rigged in secret. Every mechanism I've described today is visible, documented, and analyzable. The difference between winning and losing isn't luck or insider information. It's understanding that you're not trading Bitcoin. You're trading against market makers, liquidation engines, wash trading bots, and coordinated groups who understand market psychology better than you understand yourself. The beautiful thing about mathematics is that it doesn't care about your emotions. It doesn't care that you're excited about a technology or believe in a project. The mechanics will extract your capital with perfect efficiency, whether you understand them or not. The only question is whether you'll keep playing the game as designed, or whether you'll take the time to understand the machinery and position yourself accordingly. I started by telling you that most people think crypto is about technology. They're wrong. It's about game theory, liquidity mechanics, and information asymmetry. It always has been. The technology is brilliant, genuinely revolutionary, but the market built on top of it, that's just the oldest game in finance, running on new infrastructure with fewer rules and more sophisticated players than ever before. You now know how the crypto market really works. The question is, what are you going to do with that knowledge? Are you going to keep being the liquidity for smarter players, or are you going to adapt your strategy to survive in an environment where the house has more edges than a casino? The machinery doesn't stop. The market makers are already placing their next orders. The whales are already analyzing the next liquidation cluster. The pump and dump groups are already accumulating their next target. And the regulatory headline that will crash the market 15% next month is probably already written, just waiting for the right moment to deploy. But now, at least you can see the machine, and seeing it is the first step toward not being crushed by it. Thank you.